Ever thought about investing but felt like you needed a stack of cash just to get started? The truth is, that's a total myth. You can start with as little as $100. What matters most is taking that first step. Even with $100, you can begin building a solid financial future. What difference can $100 really make? The answer might surprise you. It's about the habits and mindset you develop. That $100 represents your commitment to learning and growing. You're opening the door to financial knowledge and opportunity. As you gain confidence, you can increase your investments. Compound interest works best with a longer runway. Imagine two investors. One starts with $100 today, while the other waits 10 years to begin investing. Who do you think will come out ahead? You might be surprised to learn that it's often the early bird, even if they invest smaller amounts. That's because time is your greatest asset when it comes to investing. Think of it like planting a tree. The sooner you plant it, the more time it has to grow into a strong, towering oak. Investing works the same way. The earlier you start, the more time your money has to benefit from compound growth. Compounding is like earning interest on your interest. It's like a snowball effect, where your money grows faster and faster over time. The longer your investment horizon, the more powerful this effect becomes. So even if you can only afford to invest a small amount right now, don't underestimate the impact of starting early. Time is on your side, and it's a powerful ally in the quest for financial freedom. Let's break down the magic of compounding with a simple example. Imagine you invest $100 today with an annual return rate of 7%. After the first year, you'd earn $7 in interest. In the second year, you're earning interest on $107. This compounding effect snowballs, and your returns start to outpace your contributions. Over 30 years, it could be worth over $800. Don't delay, invest today. Your future self will thank you. The beauty of starting with $100 is that it removes any excuses you might have for delaying your investment journey. No more waiting for the right time or feeling like you need to save up a large sum first. You can get started right now with whatever you have. Remember, the goal is not to become an overnight millionaire. It's about developing healthy financial habits, learning about the market, and watching your money grow steadily over time. The process itself is just as valuable as the potential returns. So take that first step today. Open an investment account, research beginner-friendly options, and commit to learning as much as you can. Your future self, basking in the glow of financial security, will thank you for it. All right, ready to dive into the world of investing? The first step is choosing your battlefield, or in this case, your investment platform. This is where you'll buy and sell investments, so it's essential to find one that suits your needs and budget. Think of it like choosing a gym. You wouldn't sign up for a fancy, expensive gym if you're just starting your fitness journey, right? The same goes for investing. There are platforms for every level of experience, from beginners to seasoned traders. Don't get overwhelmed by all the options out there. The key is to focus on what matters most to you. Do you prefer a hands-on approach, or would you rather have an algorithm manage your investments? Are you comfortable paying trading fees, or do you prefer a platform with low or no fees? Once you have a better understanding of your investing style and preferences, you can start narrowing down your choices. Remember, the right platform is out there, it's just a matter of finding the perfect fit for you. When it comes to investment platforms, brokerages are like the bustling marketplaces of the financial world. These platforms connect buyers and sellers of stocks, bonds, ETFs, and other investment products, making it possible for you to build a diversified portfolio. There are two main types of brokerages: full-service brokerages and discount brokerages. Full-service brokerages offer a wide range of services, including personalized advice, retirement planning, and access to complex investment products. However, this high level of service comes with higher fees. Discount brokerages, on the other hand, focus on providing a streamlined trading experience with lower fees. They typically offer fewer bells and whistles, but provide all the essential tools you need to buy and sell investments online or through their mobile apps. For beginners starting with $100, discount brokerages are often the better choice. They offer a cost-effective way to get your feet wet in the market without breaking the bank. Section 3. Robo-advisors versus DIY investing. Which path aligns with you? In addition to traditional brokerages, the rise of technology has given birth to a new breed of investment platforms, robo-advisors. These platforms use algorithms to manage your investments based on your risk tolerance, financial goals, and time horizon. Robo-advisors are a great option for hands-off investors who prefer a more automated approach. They handle all the heavy lifting, from portfolio construction to rebalancing, taking the guesswork out of investing. However, they typically charge a management fee, which can eat into your returns. If you enjoy researching investments and making your own decisions, DIY investing through a traditional brokerage might be a better fit. This gives you complete control over your portfolio and allows you to tailor your investments to your specific interests and goals. The choice between robo-advisors and DIY investing ultimately comes down to your personal preferences and how much time and effort you're willing to dedicate to managing your investments. Section 4. $100 minimums and beyond. Platforms for the budget-conscious investor. One of the biggest barriers to entry for new investors is often the minimum investment requirement. Thankfully, many platforms cater to budget-conscious investors, allowing you to start with as little as $100 or even less. Some popular options include Robinhood, Stash, and Acorns. These platforms offer a user-friendly interface, fractional shares, allowing you to buy portions of expensive stocks, and in some cases, automatic investing features. Remember to compare fees, features, and investment options before choosing a platform. Don't be afraid to shop around and find one that aligns with your financial goals and investing style. The most important thing is to get started and begin building your investment portfolio, no matter how small your initial investment may be. Section 1. Risk friend or foe, understanding your comfort zone. Before you dive headfirst into the world of investing, it's crucial to understand one fundamental concept: risk. Every investment carries some level of risk, meaning the potential for both gains and losses. The key is to find investments that align with your risk tolerance, the amount of uncertainty you're comfortable with. Think of it like a roller coaster. Some people love the thrill of a high-speed, heart-stopping ride, while others prefer a more leisurely pace. There's no right or wrong answer. It's all about what you're comfortable with. The same goes for investing. If you're young and have a long time horizon, you might be more comfortable with higher risk investments that have the potential for higher returns. On the other hand, if you're nearing retirement, you might prioritize lower risk investments to protect your nest egg. Understanding your risk tolerance is essential for making informed investment decisions and avoiding unnecessary stress. It's not about eliminating risk altogether, but managing it in a way that aligns with your financial goals and personality. Investing isn't gambling. Separating skill from chance. It's easy to fall into the trap of thinking investing is like gambling. After all, both involve putting money on the line with the hope of making a profit. However, there's a fundamental difference between the two: knowledge and strategy. Gambling is largely based on chance. You're betting on the outcome of random events, like the roll of a dice or the spin of a roulette wheel. While luck can play a role in investing, it's not the primary driver of success. Successful investing requires research, analysis, and a well-thought-out strategy. It's about understanding the fundamentals of the market, evaluating companies, and making informed decisions based on data and trends. Of course, no one can predict the market with 100% accuracy, and losses are a part of the game. However, by approaching investing with a long-term mindset and a focus on learning, you can significantly increase your chances of success. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, "Don't put all your eggs in one basket." This age-old wisdom applies perfectly to investing. Diversification is the practice of spreading your investments across different asset classes, industries, and geographical regions. Think of it like this: if you invest all your money in a single stock and that company goes bankrupt, you could lose everything. However, if you diversify your portfolio, even if one investment performs poorly, the others can cushion the blow. Diversification helps to mitigate risk by reducing your exposure to any single investment. It's like having a safety net for your portfolio, protecting you from market volatility and unexpected events. There are countless ways to diversify your portfolio, and the right approach for you will depend on your risk tolerance, time horizon, and financial goals. However, the underlying principle remains the same. Don't put all your eggs in one basket. Building your investment strategy, a marathon, not a sprint. Now that you understand the importance of risk management and diversification, it's time to start building your investment strategy. This is your roadmap to financial success, and it should outline your goals, risk tolerance, and investment choices. Remember, investing is a marathon, not a sprint. It's not about getting rich quick, but about building wealth steadily over time. Your strategy should reflect this long-term perspective and be designed to weather market fluctuations. Start by setting clear financial goals. What are you saving for? Retirement? A down payment on a house? Once you know where you're going, you can start mapping out the best route to get there. Next, determine your risk tolerance and time horizon. How much volatility are you comfortable with? How long do you plan to invest your money? These factors will influence the types of investments you choose. Remember how we talked about diversification? ETFs, or exchange-traded funds, are like the superheroes of diversification. Think of an ETF as a basket of different stocks or bonds. Instead of buying shares in a single company, you're investing in many. You could invest in a tech ETF that holds shares in dozens of tech companies. This way, you're spreading your risk and benefiting from sector growth. Index funds are like the cruise ships of the investment world. They offer a smooth, steady ride for those who want to participate in the market without the constant ups and downs of individual stock picking. Instead of trying to beat the market, index funds aim to match it. They do this by tracking a specific market index like the S&P 500, which represents the performance of 500 large-cap US companies. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of each of those 500 companies. Index funds are known for their low cost, simplicity, and long-term growth potential. They're a great option for hands-off investors who want to set it and forget it, knowing their money is working hard to capture the overall market return. Just like ETFs, index funds offer instant diversification. By investing in a single index fund, you're spreading your risk across hundreds or even thousands of stocks, reducing the impact of any single company's performance on your portfolio. So you've got your $100, you've chosen your investment platform, and you're ready to build your portfolio. Where do you begin? Remember, diversification is key, even with a small amount of money. One approach is to divide your $100 between two different ETFs or index funds. For example, you could allocate $50 to a broad market ETF that tracks the S&P 500 and $50 to an ETF that focuses on a sector you're interested in, like technology, healthcare, or renewable energy. Another option is to choose a target date fund. These funds are designed for investors saving for retirement and automatically adjust their asset allocation as you get closer to your target retirement date. The specific investments you choose will depend on your risk tolerance, time horizon, and personal interests. Don't be afraid to do your research, compare different options, and find investments that align with your financial goals. Congratulations! You've just taken the first step towards building a brighter financial future. By understanding the basics of investing, choosing the right platform, and exploring beginner-friendly options like ETFs and index funds, you're well on your way to growing your wealth even with just $100. Remember, investing is not about getting rich quick. It's a journey, a marathon, not a sprint. There will be ups and downs in the market, but by staying focused on your long-term goals, diversifying your investments, and continuing to learn and grow, you can weather any storm. Think of that initial $100 investment as a seed you're planting. With time, patience, and consistent nurturing, it has the potential to blossom into a mighty financial tree, providing you with shade, shelter, and the sweet fruits of your labor for years to come. Don't underestimate the power of starting small. Every journey begins with a single step, and your decision to invest, no matter the amount, is a testament to your commitment to building a better financial future for yourself. Now that you're armed with the knowledge and tools to start investing, it's time to take action. Open that investment account, choose your first ETF or index fund, and watch your money grow. Remember, the best time to plant a tree was 20 years ago, but the second best time is today. And hey, you don't have to go on this journey alone. Share your investment journey in the comments below. What are you investing in? What are your financial goals? Let's learn from each other, support each other, and build a community of empowered investors, one $100 investment at a time. Investing doesn't have to be intimidating or complicated. With the right resources and a little bit of effort, anyone can become a successful investor. So, what are you waiting for? Start investing in yourself and your future today.